Debits and credits is a fundamental accounting concept, and no course on financial statement analysis would be complete without discussing it. When students think of accounting and financial statements, debits and credits is generally one of the first topics they think of, but the concept isn't exactly intuitive at first. So let's take a look at it here. Now, financial statements as they're reported are the result of all the financial transactions that have occurred over time. Every time a financial transaction occurs, it's recorded in a journal or what's called a general ledger, which looks something like what you see here on the screen. Each journal entry consists of two entries, one of which is called a debit and the other of which is called a credit. Debits and credits are recorded in the following manner, with the debit on top and the credit on bottom and slightly indented to the right. And for each entry, total debits will always equal total credits so that our books remain in balance. Now, as a general rule, debits are used to record expenses, increases in asset accounts, reductions in liabilities, and reductions in equity. Credits function in the opposite manner, so credits are used to record revenues, reductions in assets, increases in liabilities, or increases in equity. So now that we understand the basics of debits and credits, let's walk through a few scenarios. Alright, so in this exercise, I'm going to walk you through some common financial transactions and show you how the journal entries would look in each scenario. And I've posted the general rules off to the top right corner, and this will help guide you along the way. So for our first scenario, let's assume that the company buys a piece of equipment for $100,000 using cash on March 1st. In this situation, the company is trading one asset, cash, for another asset, equipment. And remember that an increase in assets is a debit and a decrease in assets is a credit. So in this instance, the company would record a $100,000 debit to equipment and a $100,000 credit for cash. On the balance sheet, the company would increase its equipment balance by $100,000 and reduce its cash balance by $100,000. In scenario number 2, a few days later, the company receives a $500,000 loan. When a company takes on a loan, it receives cash immediately in return for a promise to repay that cash over a period of time. The cash received is an asset, and the promise to repay is a liability. So in this instance, the company records a $500,000 debit to cash and a $500,000 credit to long-term debt. And on the balance sheet, cash rises by $500,000 and debt increases by $500,000 as soon as that company receives that loan. The third scenario is a two-part financial transaction. In the first part of this transaction, the business provides a $700 service on credit. So what this means is that the customer doesn't actually need to pay cash on the spot for services. And in this scenario, the company completes the service on March 15th, and the customer has 15 days to pay. So the asset in this scenario is an account receivable, which is a business's right to be paid for services performed, and the offsetting credit is revenue, which is recorded at the time services are provided. Now, 15 days later, that same customer pays $700 in cash for services previously rendered. So in this situation, we're again trading one asset for another, with the receipt of cash satisfying the account receivable. So the debit in this transaction is cash, and the credit is to accounts receivable. Now this is really just the tip of the iceberg when it comes to debits and credits, and I encourage you to post any questions that you have in the Q&A section below. In the next lesson, I'll show you how to use the SEC website to pull financial data on publicly traded companies. I'll see you in the next video.